Good morning. The apartment market is showing early signs of stabilization. And after more than a year of softening fundamentals, driven mostly by record construction, but also by moderating demand, the U.S. apartment market is beginning to show early signs of stabilization. And recent data from RealPage indicates that occupancy and rents have increased for 2 consecutive months, suggesting that the multifamily sector may be transitioning away from the correction phase that dominated late of 2025. And for commercial real estate investors, this shift could mark the beginning of a new cycle for multifamily assets heading into 2026 and beyond. So, occupancy levels are gradually improving. And apartment occupancy reached about 94.8%, about 95% in February, according to RealPage data. And this represents 2 consecutive monthly increases of about 10 basis points, 0.1%. And that's a positive signal after several months of declining occupancy during the second half of 2025. However, perspective is important here, and occupancy remains 10 basis points below year-ago levels and roughly 90 basis points below the April 2025 peak. So in other words, the market is not booming yet again, but it's appearing to be moving forward towards equilibrium. And for investors, stabilization often creates better buying opportunities than boom periods, and when pricing and competition tend to surge as well. So rent growth has turned slightly positive, and that's another encouraging indicator, and that's rent growth is returning to positive territory. So effective asking rents rose about 0.3% month over month in February, marking the second consecutive monthly increase after about 7 months of just stable stagnation. Now, however, on an annual basis, rents remain about 0.4% lower than a year ago. So that means the market is still absorbing a large wave of the new apartment deliveries. But the key takeaway is clear, and that is rent growth is stabilizing, but not yet accelerating. So for investors, this environment often favors long-term buyers rather than short-term speculators. So the Sunbelt markets are still feeling supply pressure, and regional performance across the U.S. remains uneven. Many Sunbelt markets, which also saw the most aggressive apartment development over the past 3 years, are still experiencing pricing pressure right now. And markets facing the steepest rent declines include some of the following: Austin, Denver, Phoenix, Charlotte. And these cities are dealing with elevated supply pipelines. So a lot of construction deliveries, and that's forcing operators to offer concessions and rent discounts to be able to maintain occupancy in their buildings. And in fact, the southern U.S. has now gone nearly 3 years without consistent annual rent growth. So let's talk about coastal tech hubs and Midwest markets that are outperforming. While Sunbelt markets work through supply challenges, several other regions are actually performing better right now. Coastal technology hubs have seen strong rent growth. So think San Francisco, San Jose, New York. And these cities have recorded annual rent increases between 4.5% and 9%. And that's likely driven by tech hiring, and there's recovery there. That there was a pause, but limited new supply being delivered, but also high barriers to development in those markets. Meanwhile, several Midwest markets are quietly outperforming as well, and those include Chicago, Cleveland, Cincinnati, St. Louis, but also Minneapolis and Kansas City. And these metros are benefiting from more stable employment and lower construction activity, but also strong renter demand. So the supply wave is beginning to slow. And perhaps the most important factor supporting stabilization is the expected slowdown in new apartment construction. And over the past several years, developers have delivered record numbers of multifamily units, which temporarily push supply ahead of demand. But that pipeline is now starting to moderate. And as construction activity slows, two things typically occur in the market. One is that occupancy improves, and two is that rent growth returns. And if the supply slowdown continues through the spring and the summer leasing seasons, many analysts expect fundamentals to strengthen further in late 2026 and into 2027. So, what does this mean for investors in multifamily? Well, for commercial real estate investors, the current environment may represent a strategic entry point into multifamily assets. And some markets that are moving from correction to stabilization often present attractive opportunities because sellers may still be adjusting to new pricing expectations. And interest rates are beginning to stabilize, so you can qualify a little bit more of a loan. And rent growth may resume gradually, is kind of the outlook that we're hoping for. And that means that disciplined investors will often focus on strong job growth markets and submarkets with limited new supply, but also properties with operational upside, so value add type deals. And these fundamentals typically drive long-term value creation in multifamily real estate. And Houston's multifamily market remains a key market to watch. Now, for investors focused on Texas commercial real estate, Houston continues to stand out as a structurally resilient multifamily market. And some of the key drivers for interest in our community is, population growth. People are relocating here. Corporations are relocating here. And there's also energy and manufacturing expansion. But also there's a big infrastructure investment in the city. And while Houston has also experienced new apartment deliveries, the region's diverse economy and continued population inflows have helped maintain strong absorption over time. And this dynamic is one of the many reasons why institutional lenders and investors continue to view Houston as a core multifamily market heading into the next cycle. So, what's the bottom line here today? Well, that is that the U.S. apartment market is not experiencing a dramatic rebound by any means, but at least the latest data suggests it may be transitioning from a correction phase towards a stabilization phase. So, positive momentum is the point. And as new supply moderates and leasing patterns normalize, the multifamily sector could see gradual improvements in occupancy as well as rent growth throughout 2026. And for investors who understand market cycles, this phase often represents one of the most strategic moments to enter the market. So if you want to look at and evaluate some multifamily projects, please reach out. My website is houstonrealestatebrokerage.com. You can figure out how to get a hold of me there. Love to talk to you more. Take care.